Scott Besson leans into the microphone on Capitol Hill, his voice steady, but his words cutting through the chamber like static. The status quo with China is working pretty well. For a moment, the room tilts. The United States has spent years calling Beijing its greatest rival. Yet its own Treasury Secretary now defends the arrangement. The cameras pan, catching his composure. Outside these walls, US farmers stare at silos overflowing with unsold soybeans. Tech investors watch the Nasdaq bleeding red, and Japanese officials scan reports showing their exports just suffered the steepest drop in 4 years. At the very moment the trade war was supposed to peak, Washington's chief economic strategist sounds more like China's shield than its adversary. That is where we begin. Not at build-up, not at theory, but in the contradiction itself. Russia's sanctions were meant to choke supply. Yet Bloomberg data shows nearly 3 million barrels of crude still flow daily to India and China. Instead of isolating Moscow, the sanctions redirected profits. India alone has reaped about $16 billion in resale margins, Reuters reported, with its wealthiest families pocketing the spread. The hypothesis that cutting Russia's revenue would weaken China's industrial advantage runs into a harsher reality. Beijing still imports discounted oil, keeping manufacturing costs low. Meanwhile, American producers shoulder higher input prices. What was sold as strategic pressure looks in practice like a subsidy for Asia's resilience. Then agriculture illustrates the fallout with brutal clarity. In 2023, China bought nearly 5 million tons of US soybeans. By 2025, that number has fallen to zero. USDA data shows total US soybean exports have plunging from just over 10 million tons to under 5 million. Farmers, once the poster child of American competitiveness, now face machinery costs up 20 to 30%. In some cases, 50 or even 80% as tariffs inflate steel and input prices. Loans for new crops resemble casino bets. China's demand has not vanished, it has shifted. Brazil and Argentina now cover Beijing's needs, and state stockpiles in China are full. Neutral analysis suggests the tariff war achieved not leverage, but permanent realignment. It is here that Bessent's words land harder. Tariffs, he explains, are working pretty well because China is the largest single line of US tariff revenue. But that claim conceals a contradiction. Tariffs are paid not by Chinese exporters, but by US companies importing goods. The Wall Street Journal has emphasized this repeatedly. Tariffs function as a domestic tax. Washington banks the revenue, but at the expense of its own industries. When Bessent defends the status quo, what he is really defending is fiscal oxygen for the Treasury. The trade war survives not as punishment against Beijing, but as a tax engine on American consumers. What was marketed as toughness has mutated into dependence, and the collateral damage spreads outward. Japan's Ministry of Finance reported that exports fell 2.6%, 6% in July, which is actually the sharpest decline since 2021. Automobiles and auto parts plunged by 28.4% and 17.4% in value on shipments to the United States. Toyota alone warned of a 1.4 trillion yen, or about 9.5 billion, hit to its bottom line. Imports of crude, coal, and LG shrank by double digits, signaling weaker factory output. The trade balance flipped to a deficit of 117.5 billion yen. These figures reveal a country sliding from surplus to fragility. Neutral evaluation suggests Washington's tariffs intended to strengthen US industry are instead hollowing out one of its closest allies. Bessent insists that continuity is working. Working for whom? For the Treasury's revenue column? Yes. For Chinese diversification? Arguably for American farmers and Japanese manufacturers? Clearly not. Tariffs in effect have inverted their role, less a tool of foreign leverage, more a domestic tax regime. By extension, Washington has become relying on the very flows of trade it labels hostile. A strategy meant to break Beijing is quietly binding Washington to it. The crisis escalates further when the Federal Reserve enters. Minutes from the July 29th to 30th meeting show most policymakers judged inflation as the greatest systemic risk, meaning rates will stay high despite weaker employment. US debt, already at $37 trillion, could climb past $38 trillion by year's end, according to Bloomberg. To finance that debt, Bessent must oversee bond auctions at ever higher yields, and here the callback matters. Every week, auction piles pressure directly on his desk. That's why his defense of the China status quo is more than rhetoric. It's survival. If tariffs collapse, so does a revenue stream cushioning treasury auctions already under strain. Higher yields mean borrowing costs spike across the economy, crushing over-leveraged firms. The Nasdaq's recent 2% dive was not just about rates. It reflected fragility in the tech sector. And that fragility leads straight back to Beijing. The US AI boom from cloud to semiconductors requires rare earth minerals. Reuters reported shipments of rare earths from China to the US surged 76% in June after being nearly zero in May. The number is striking from famine to feast in a single month. What if Beijing shuts the valve again? Fighter jets, electric cars, and AI chips alike would stall. Washington cannot finance its own future without Chinese minerals, even as it brands Beijing the strategic enemy. Now it begs these questions. If America taxes its own consumers to fund a tariff war, if its treasury depends on Chinese trade to stabilize auctions, and if its tech firms depend on Chinese minerals to survive, then what exactly is this? Conflict, rivalry, dependence, or both at once? Everyday language makes it sharper. Why does America now pay more to borrow its own money than China does to fund its rise? That question doesn't need ideology, it demands logic. Japan's fragility pushes the narrative further. Bond yields at Tokyo's 20-year auction rose to 2.61%, signaling that investors doubt its debt sustainability. With debt to GDP nearing 250%, Japan cannot borrow its way out. Exports are down, imports are down, but the trade balance is still negative. A manufacturing powerhouse drifts toward deficit. Neutral analysis points to one path: alignment with China. Already, India is moving closer after Washington's tariffs on refined fuels. Mod's meeting with Chinese Foreign Minister Wang Yi underscored that pivot. If India and Japan both gravitate toward Beijing, America's tariff strategy accelerates the multipolar order it fears most. What makes the picture more combustible is how global finance is already reacting. According to the Financial Times, central banks in emerging markets have accelerated gold purchases, adding over 800 tons in the past year, the fastest pace since records began. Why? To reduce dollar exposure as tariff battles and debt auctions shake confidence in US fiscal discipline. At the same time, SWIFT transaction data shows the Chinese renminbi now accounts for more than 5% of global payments, its highest share ever, climbing from under 2% just 5 years ago. Every percentage point gained comes at the dollar's expense, a slow erosion of the very foundation that allows Washington to borrow cheaply. Meanwhile, foreign holdings of US treasuries tell their own story. Japan, once the largest creditor, has been cutting back with holdings dropping below $1.1 trillion, the lowest in more than a decade. Canada, too, has trimmed exposure by tens of billions. These are not abstract moves. They signal that even allies are unwilling to finance America's debt at the scale they once did. And each time they step back, the burden shifts back onto Bessent's treasury, forcing auctions at higher yields that ripple across mortgage markets, corporate loans, and municipal budgets. Washington insists tariffs and sanctions demonstrate control. Yet, the underlying numbers suggest vulnerability. Every shift toward gold, every renminbi transaction, every treasury sale points to the same conclusion. Others are hedging against America's strategy, and in doing so, they are accelerating the costs of that strategy at home. Trump's tariffs were framed as tools of strength, yet the evidence Japanese export collapse, US debt escalation, rare earth dependence shows them functioning as accelerants of global realignment. Allies are destabilized, adversaries adapt, and Washington's own treasury grows reliant on Beijing's trade flows. Neutral evaluation finds little evidence that tariffs weaken China. Instead, Beijing secures energy inflows, agricultural alternatives, and leverage over critical minerals. Washington secures revenue, but only by taxing its own consumers. And so, we return to Bisa. His words on Cap Hill, no longer sound like betrayal, but inevitability. The status quo with China is not working in the way slogans imply. It is working for a treasury desperate to stabilize auctions, for a government addicted to tariff revenue, and for an economy too entangled to unwind. Neutral analysis leaves no easy conclusion except this: the trade war has inverted. What began as punishment has become reliance. What began as leverage has become dependence. America cannot end the conflict without losing fiscal oxygen, nor can it prolong it without bleeding its allies. The US Treasury Secretary defending China is not the twist. It is the truth revealed. Confrontation and dependence now live in the same sentence. And the policies meant to isolate Beijing are instead isolating Washington, forcing its own chief economic officer to defend the adversary his government vowed to weaken.